Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. The true break below the lower bull channel line of the second bull channel 2 weeks ago and the subsequent confirmed break below the declining long moving average, currently at 1464.3 that same week, was the final end of the bullish incentive started back from the break up and out of the late 2022 ascending triangle. I asked a question last week and also postulated some answers. Thus, on a most important question, and I quote, "Question now is what will be next?" Now you may say that all this action since last October is part of an ascending inverted scallop pattern, or you may say it's part of a bump and run reversal top pattern. In both cases I'd agree. There are elements of both those patterns here, but not enough to say is one or the other. Hence I chose to look at the longer term charts and see if I could gain a clue as to what will be next. Looking at these longer term charts provoked the following comments, and I quote, "Possibility that we now had a February 2021 to date bear flag. This has set up the opportunity. It will very much depend now on two factors." Looking back at the more recent action, I expanded on this, and I quote, "Will the market halt at the congestion at 1378 that had formed the lower trend line of the descending triangle from late last year? And if not, will it halt at the July 22 low at 1304? If the answer is no to both, then we may well have a bear flag formation potential down as far as the 1120 zone. Quite a big move if it does come about." That's the end of the quote. Well, late last week we had an initial indication that the market was not happy about heading below the base of the old descending triangle from late last year, as last Friday's reactionary move back up with a bullisher army showed us. This move back up placed the market within a fairly free area, much as last week's move down had also done, and prices rose up all the way to where we are right now at the 50% Fibonacci line of the December 2020 to February 2022 move at 1451. However, whilst I still value this 50% Fibonacci line as a support and resistance level, I think a potentially greater force is now moving down to not only impinge upon the market, but to also reinforce the 50% Fibonacci line, and that is the declining long moving average, currently at 1463, and the one I spoke about earlier that had been broken 2 weeks ago. Not only that, but we have the flatlining medium moving average, currently 1485, is only a little higher. Thus it's worth paying special attention to these two moving averages and what the market will do on approach to them, if they do indeed approach. It also means, despite the rejection of the move lower last week, that the idea of a big bear flag may still be on the table. I'm sorry, I know I'm repeating myself yet again, but the situation deserves repetition. You see, for months now, we've had different patterns, not so much melding in with each other, but rather crashing in and out of each other. The bigger pattern here is the May to date seemingly broken, then repaired, ascending expanding wedge pattern. A huge pattern I had pointed out many months ago. This had developed for a while, but is now looking pretty ill. It was never a perfect pattern by any means, but it had seemed to work until the end of last year. To assist in seeing this pattern, I've highlighted it in dark blue. It's worth noting that the lower trend line is also the neckline of the huge December 2021 to June 2022 head and shoulders continuation pattern, and that's currently at 419.5. I'm still thinking about downgrading it, as there's enough else going on nearby that deserves some closer and better attention. The next patterns to look at are the ones that caused the peak of the market in early and late December last year. It was a combination of the 2021 high at 471.40, inflamed. Yes, I think that's a good way to describe it. Inflamed by the neckline, which I've highlighted in bright red, of the February to April 2022 head and shoulders top, currently at 481.80. I should perhaps clarify that the June 2014 high at 479.30 has also helped in this matter. Prices tried moving higher and away from the 2021 high, the June 2014 high, and even up and away over the bright red neckline, However, these moves higher brought the market into conflict with fresh resistances, such as the 2022 high at 491.5 and a 2014 high at 494.40. The market breached both of these, but was not able to break them, and fell away in the middle of March. So, this has left us with what happened since the peak in early March, and the subsequent move lower. The top of the market was an seemingly innocuous bearish harami 3 weeks ago. However, I suspect it was the combined key reversal down and bearish engulfing pattern made 3 Mondays ago that really started the move lower. Enough that as we stand now, we are set up for a potential monthly key reversal down. Thus, if we close tomorrow, and that's the 31st of March, either over 468.5 or under 467.10, then we'd be on. Right now, we are most emphatically looking at a monthly key reversal down. Now, if we look in detail at last week and this week's actions, we can see a small hesitation at the medium moving average, currently 454.60, last Wednesday. On the way down, and a reversible back up from a combination of the early April 2021 high and congestion and highs from January and February 2021 at 433.5, plus the influence of the descending long moving average, that's currently 437.30. This combination caused the bullish harami last Friday and the subsequent small recovery. Yet the recovery seems limited, this time by the medium moving average, which is above, which has been breached but not broken this week. In the immediate short term, this leads me to think that perhaps we may be starting to form a trading range between the long moving average below and the medium moving average above, though I'm not very wedded to that idea just yet, and only gave the thought of a possible bear flag or bearish halfway hesitation being built a passing glance. No. To the bigger picture, I will again look at the longer term charts as I did last week. I said last week, and I quote again, here we can see the potential monthly key reversal down, but also the possibility for a double top formed over Q4 2021 to date. On this one, it will all depend on what the market does once it comes into close proximity to the 50% Fibonacci line for this move at 403.60, should it get down to those levels. End of quote. Back now to the more recent view, and you can see that whilst the potential range trading between the medium and long moving averages mentioned earlier is important, in the big picture, the old neckline come lower trend line, currently at 419.5, of the ascending expanding wedge pattern may be more important, especially if the nascent idea of a bear flag type action grows in any significance. Then, of course, there is the support of the 50% Fibonacci line of 403.60 in amongst the congestion that stretches from 415.5 down to the 400 zone. That may well be the key to what may happen. Chicago soybean oil. I'll once again discuss some of the key recent features as I've done for many weeks, but I will first address last week and this week's elephant in the room, the weekly key reversal down last week and the complete lack of follow through this week. Last week's weekly key reversal down was a good pattern. It just seems that the market was just not ready yet to punch down through the March 2013 high at 51.26. However, even now the reaction back up has been of a limited fashion, with prices barely making it over halfway of last week's range. I will also reference the March-based bear flag formation shortly, but first I would like to look at the previously mentioned key recent features here. They've been the same for quite a while, though they are now changing. Feature 1 is the lower time, currently at 62.55 of the December 2021 to June 2022 bullish shift pitch wall, which I've highlighted in dark blue on my daily chart. This lower time, along with feature 2, the broken April 2020 to date uptrend, currently at 63.68, which I've highlighted separately in bright red, both halted a decline in mid-December last year, starting a small subsequent move higher with the help of a whole series of other supportive features, including the 2011 high at 61 even, the supports at 59.44 and 58.82 to 58.16, inside of which is the August 2011 high at 58.59, plus the September 2012 high at 57.64. Back in December last year, these all caused the market to revert back up and in the process form a small ascending wedge pattern. Now I've highlighted the pattern in bright green on my daily chart. In late December, the market broke down through the base of the pattern, thus initiating a primary target in the 64.08 zone and a secondary, much harder to reach target in the 58.82 zone. The primary target was easily reached, but it took until early February to graze down to the secondary target before being rejected back up again. Yet this rejection was not substantial enough, as prices did not manage to effectively push higher, stalling ahead of the 50% Fibonacci on the January 21 to April 22 move at 64.10, and barely managing to regain the broken uptrend and the broken lower time before heading back down again in early March. This time we saw a heavier move down to and through the secondary target at 58.82 and through the supports underneath it from 58.82 to 58.16. For a while we saw congestion during the middle of March, but last week the fall started again with what turned out to be a bear flag pattern formed over March, which had seen the target for the pattern below reached and a possible weekly key reversal last week. So all in all, we've recently formed a small bear flag, fulfilled its potential and immediately turned back up. But the recovery is showing signs of weariness. Meanwhile, the longer term picture still has opportunities on the downside, and this week's reactionary move up fortifies those ideas. You see, as I said last week, and I quote, looking at the longer term chart, and we can see a topping action in formation, though whether it is a lopsided head and shoulders top or a lopsided diamond pattern is still a little open. What we can see is that the 5110 to 5120 area is key because of the low from December 2021. Below that, we seem to have a fairly free area until the 50% absolute Fibonacci line of 43.82.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.